While everyone's panicking at the pump, a small group of people are actually getting richer off the same thing that's draining your wallet. Hey, before we dive in, I gotta be clear about something. I'm not a financial advisor. Everything you're about to hear is purely educational content. Gas prices spike, you get angry, you complain about it, then you pay whatever they're charging because you need to get to work. And you move on, but that's a consumer mindset. And consumers get squeezed. Investors see gas prices spiking and they see opportunity. They see a chance to actually profit from the same pain everyone else is experiencing. And most people have no idea this is even possible. Here's the thing, gas prices don't move randomly. They're connected to global oil markets, supply chains, geopolitical events, and financial speculation. And if you understand those connections, you can position yourself to benefit when prices move. Most people think their only option is to suffer, but there are actually ways to turn rising gas prices into gains. Let's talk about the most obvious one first, energy stocks. When gas prices go up, oil companies make more money. It's that simple. Exxon, Chevron, Shell, BP. These companies see their profits explode when crude oil prices spike. And here's what most people miss. You can own a piece of those companies, you can buy their stock, and when gas prices go up and their profits surge, your investment goes up too. So while you're paying $5 a gallon and cursing the oil companies, you could literally be owning a piece of the company making money off you. But it gets more sophisticated than just buying oil stock. There are ETFs, exchange traded funds that track oil prices directly. They're designed so that when oil goes up, the fund goes up. You don't have to pick individual companies. You just buy a fund that moves with crude oil prices. This is how sophisticated investors hedge against inflation. They don't just hold cash that loses value, they own assets that go up when the economy gets squeezed. But here's where it gets really interesting. Options trading on energy stocks. This is more advanced, but it's important you understand the concept. When you think oil prices are about to spike, you can buy call options on energy companies. Those options let you bet that the stock will go up without actually having to buy the stock itself. If you're right and oil spikes and energy stocks soar, you make a multiple of your investment. If you're wrong, you only lose what you paid for the option. This is leverage. This is how people turn a small amount of capital into serious gains. And it happens every time gas prices move significantly. But most people don't even know this is possible. They just pay more at the pump and accept it. Now here's the psychological part that's important. Gas prices going up is bad for the economy. It's bad for consumers. It causes real pain. But from an investment perspective, it's actually a signal. It's information. It's a market opportunity. The people who understand this aren't evil. They're just not stuck in the consumer mindset. They understand that in every crisis, in every disruption, there's a profitable side if you know where to look. Let's talk about energy infrastructure stocks too. When gas gets expensive, people want alternatives. They start looking at electric vehicles. They start investing in solar panels. They look for ways to reduce energy consumption. Companies that build that infrastructure, that provide those solutions, they see their business explode. Tesla doesn't just sell cars. They benefit from the psychology of people trying to escape high gas prices. Same with renewable energy companies. When energy becomes expensive, renewable energy becomes more competitive. The economics shift. Investments that weren't viable before suddenly make sense. So you've got multiple ways to profit from the same event that's crushing consumers. But here's the key thing most people miss. This isn't market manipulation. It's not unfair. It's literally how markets work. When something becomes scarce or expensive, prices go up, profits increase, and investors who own pieces of those profitable things make money. This is basic supply and demand translated into the financial markets. The only reason it seems unfair is because most people are on the consumer side of the equation. They're the ones paying. They never even consider the investor side where people are making money. But that choice is available to you too. You can stay on the consumer side, paying whatever the market demands, or you can move to the investor side and actually benefit from market movements. Here's what you actually need to do. First, open a brokerage account if you don't have one already. Fidelity, Vanguard, Charles Schwab, doesn't matter. You need to be able to buy stocks and ETFs. Then, research energy sector ETFs, XLE, OIH, DBC. These track oil prices and energy companies. Understand how they move. Look at their historical performance when oil prices spike. Third, start small. Buy a little bit. Get comfortable with how this works before you make bigger moves. Then, pay attention to what causes oil prices to move. Geopolitics, supply disruptions, demand shocks, currency movements. The more you understand the drivers, the better you can anticipate moves and position yourself. This isn't about getting rich quick. It's about understanding that the same event that hurts you as a consumer can benefit you as an investor. And the people who do this successfully, they're just thinking differently about the same situation everyone else is experiencing. If you want to understand how to think like an investor instead of a consumer, how to see opportunity where most people see only problems, hit subscribe, because this is what separates the people building wealth from the people just surviving.